December 20, 2025. Mark this date. Put a circle around it on your calendar, because when the history books are written, they will mark this weekend as the day the financial system finally died. Did you see what happened yesterday when the markets closed? Most of you didn't. Most of you were staring at that little app on your phone, hypnotized by that fake flashing number, that $74 price tag. But behind the scenes, in the glass towers of the too-big-to-fail banks, inside those dark server rooms where algorithms trade at the speed of light, something broke. Mathematics broke. Yesterday, at exactly 4 p.m. Eastern Time, the monthly silver options expired. Remember what I have been telling you for weeks, maybe months? There were 40,000 call option contracts sitting at the $70 strike price. That is not just a number on a screen. That represents a legal obligation for the market makers to deliver 200 million ounces of physical silver. When the closing bell rang yesterday, they tried their usual trick. They tried to paint the tape. You saw that sharp drop on the charts, didn't you? That massive red candle pushing the price from $78 down to $72 in seconds. Everyone on Twitter said, "Oh, look, they did it again. The banks won. The price is smashed." But you are wrong. This time, they didn't win. This time, they didn't escape. Because this time, they weren't betting against fearful retail speculators. They were betting against industrial giants who have factories to run. If you dig deep into the data, and I mean deep, into the reports that Bloomberg won't show you, the COMEX released its delivery notices report late last night, and there is a terrifying detail buried in those columns. The mainstream media won't touch this. CNBC will tell you it's just profit-taking, but I'm going to show you the cold, hard reality that only mathematics can prove. As of yesterday's close, JP Morgan and the other commercial banks entered into a delivery obligation for 85 million ounces of silver that they do not have. Let me repeat that, 85 million ounces. They sold it, they took the money for it, but it's not in their vault. Do you know how much silver is actually sitting in the COMEX registered category right now, this Saturday morning, available for delivery? 42 million ounces. Do the math. Please, just do the simple elementary school subtraction. Demanded, 85 million. Available, 42 million. The deficit, 43 million ounces. This is not a short squeeze. This isn't even a gamma squeeze yet. In technical financial terms, this is called a default. The banks are technically insolvent as of last night, but they won't tell you that. They will stay silent all weekend. And before the markets open on Monday morning, the CFTC will likely declare a market emergency. They will change the rules. They will tell you, to preserve market integrity, we're only allowing cash settlement. Translation? They will say, I know I signed a contract to give you silver, but I don't have any silver. So here, take this worthless paper dollar, take this digital credit, and shut your mouth. This is exactly what I mean when I talk about the Great Decoupling, and it is happening right now, this very second. The link between the screen price and the real price has been severed. Last night, we saw unprecedented moves in the London physical market and the Shanghai gold exchange. Right now, if you convert the currency, silver in Shanghai is trading at $92. In New York, the screen says $74. That's an $18 spread. How is that possible? It's the same element, atomic number 47, same purity, yet it costs 92 units on one side of the world and 74 on the other. In a functional market, arbitrage traders would buy in New York and sell in Shanghai to close that gap instantly. But they can't. Do you know why? Because there is no silver in New York to buy. That $74 price is the price of a ghost. It's the price of a paper promise. The $92 in Shanghai, that's the price of the real metal you can hold in your hand. This is the official confirmation that the COMEX is no longer a metals exchange. It is a paper casino. If you hold a COMEX contract or a silver ETF, I'm sorry to tell you this, but you don't own silver. You own a lie.
Now, to understand the hell that is going to break loose on Monday, you need to understand the mechanics of why this is happening. You ask, how can they run out? How can the masters of the universe, the banks that own the world, run out of silver? The answer is simple and terrifying: leverage. For decades, they ran this market with the same magic trick. They put 1 ounce of physical silver in the vault, and then they printed 500 paper ounces to sell to investors. As long as everyone didn't ask for their metal at the same time, the Ponzi scheme worked. The banks would print paper to smash the price when it got too high and buy it back when it got too low. They owned the casino. The dice were loaded. But in 2025, the game changed. It wasn't just speculators at the table anymore. It was Tesla. It was Samsung. It was Apple. It was the military-industrial complex. These companies need silver. They don't care about the spot price on a screen. They care about keeping their assembly lines moving. They need physical metal for chips, for solar panels, for advanced batteries. And yesterday, when the options expired, these industrial giants looked at the banks and said, "We don't want your cash settlement, we want our metal." That was the moment the system locked up. JP Morgan's bluff was called. What we are living through right now is not like 2008. In 2008, the problem was toxic debt, bad mortgages. Today, the problem is absent assets. In 2008, the Federal Reserve could print money to fill the hole, but the Fed cannot print silver. You cannot type a code into a computer and manifest silver into existence. You have to dig it out of the ground. And if you look at the mining reports, production in Mexico is down 12% due to energy costs. Strikes in Peru have halted shipments. So here is the picture. On one side, exploding industrial demand that cannot be stopped. On the other side, mining supply that is collapsing. And right in the middle, arrogant banks that sold silver they didn't own, leveraged 500 to 1. This isn't a storm. This is a mathematical certainty. It is financial physics. An object cannot be in 2 places at once. That ounce of silver is either in your safe or it's in the bank's vault. And now we know it's not in the bank's vault. Can you imagine the phone calls happening this weekend? The lights at the New York Fed aren't going off tonight. They are desperate. They are calling vaults in London, in Zurich, in Singapore. They are trying to borrow inventory. They are begging South Korea, Turkey, Poland, loan us 10 million ounces. We'll pay you back next week with interest. But nobody is selling. The phone lines are dead because everyone knows. Everyone saw the ship take on water yesterday. Nobody lends their life jacket to a drowning captain. This silence you hear is not the silence of peace. It's the shockwave silence right after the explosion, just before the building collapses. To understand what is about to happen on Monday morning, you have to realize that this silence we are witnessing this weekend is not unprecedented. We have seen this exact movie before. The script is dusty, but the plot is identical. The last time the banks were this trapped, the last time the physical shortage was this undeniable, was January 1980. They call it the Hunt Brothers bubble. The media told you that 2 greedy brothers from Texas tried to corner the market and failed. That is the lie they teach in business schools. The truth is far simpler and far more dangerous. The Hunt brothers didn't corner the market. They simply exposed that the banks didn't have the silver they had sold. The Hunts demanded delivery.
They wanted the metal, not the paper. And when the New York bankers realized they were about to default, they didn't play by the rules, they changed them. On January 21, 1980, the exchange announced Silver Rule 7. It was a liquidation-only order. It meant you could sell silver, but you were legally banned from buying it. Think about that for a second. Imagine a stock market where the buy button is disabled by the government and only the sell button works. What happens to the price? It crashes. It was a manufactured crash designed to save the banks and bankrupt the physical holders. Fast forward to December 20, 2025, today. Why am I telling you this history lesson? Because my sources in Washington are whispering that a similar emergency measure is being drafted right now. The CFTC, the Commodity Futures Trading Commission, is likely in a closed-door meeting as I speak. They are looking at the same data I am looking at, and they are terrified. They know that if they open the market on Monday without restrictions, the price won't just rise, it will teleport. Why? Because of the gamma trap. This is the technical part, so listen closely. This is the mechanism that turns a normal price rise into a nuclear explosion. When a bank sells a call option, they're betting the price will stay down. But if the price starts to rise, they have to hedge. They have to buy futures contracts to protect themselves. This is called delta hedging. Here is the nightmare scenario they are facing. When silver hit $74 yesterday, the delta on those millions of call options contracts spiked. To stay neutral, the algorithms, not humans but automatic code, were forced to buy more futures. But buying futures pushes the price up. Higher price means higher delta. Higher delta means they have to buy even more futures. It is a feedback loop from hell. Price up, algorithms buy. Price goes higher, algorithms buy more. Usually there are sellers to absorb this buying, but remember what I told you in part 1? There is no physical silver left in the registered vaults. The miners are holding back supply. The recycling plants are empty. So the algorithms are trying to buy something that doesn't exist. This is what happened to GameStop in 2021, but on a planetary scale. GameStop was a $20 stock that went to $480 because of this exact mechanism. Silver is not a video game store. It is the strategic metal that powers our entire digital economy. And sitting right in the center of this trap is the biggest player of them all. We don't have to name names, but we know who holds the largest short position in the commercial category. Let's call them the whale. For 15 years, they have suppressed the price, printing paper contracts to keep silver cheap. They thought they were the masters of the universe. They thought they could print paper silver forever. But mathematics is a cruel mistress. You cannot print an element on the periodic table. Yesterday, millions of ounces of in-the-money call options expired. Do you know what that means for the whale? It means they have to deliver the metal, not cash, metal, by next week. If they don't have it, they have to go into the open market and buy it. Imagine the chaos on Monday. The biggest bank in America forced to enter the market as a desperate buyer, indiscriminately hitting every ask price on the screen, trying to find 85 million ounces of silver. It's like an elephant trying to hide in a bathtub. The water is going to overflow. The entire room is going to flood.
And this brings us to the most critical realization of this weekend. The spot price you see on your screen is about to become irrelevant. We are entering the phase of backwardation. This is a fancy finance term that means right now is more expensive than later. Usually, if you buy something for delivery next year, it costs more because of storage and insurance. But right now, immediate delivery is trading at a massive premium. Why? Because nobody trusts that the metal will be there next year. The trust is gone. The system relies on confidence. It relies on you believing that the piece of paper in your portfolio is as good as a silver bar in your hand. That belief died yesterday at 4 p.m. Look at the premiums. Go to any online bullion dealer right now. If you can even find stock, which I doubt, look at the price over spot. The paper price says $74. The physical dealers are asking $95, maybe $100. That gap, that spread, is the sound of the paper market dying. It is the sound of the dam cracking before the water bursts through. The banks are praying for a miracle this weekend. They are praying that you, the retail investor, will panic. They want you to look at the volatility and get scared. They want you to sell your physical stack back to them so they can cover their shorts. They are going to unleash a media blitz. You will see headlines tomorrow. Silver bubble bursts. Regulators step in. Experts warn of manipulation. Do not listen to them. They are not warning you. They are trying to rob you. They need your silver because they sold it to someone else, and now the bill has come due. The Great Decoupling means that from this point forward, there will be two prices for silver. The paper price, controlled by the CFTC, suppressed, managed, and ultimately meaningless. The street price, the real price, the price you pay if you actually want the metal, and this price has no ceiling. In 1923 Weimar Germany, during the hyperinflation, gold didn't just go up, the paper currency went to zero. People were trading silver coins for entire city blocks of real estate. We are not there yet, but the mechanics are the same. Debt is the fuel, and the derivative market is the match. Yesterday, someone lit the match. So as we stare into the abyss of Monday morning, you have to ask yourself a question, not a financial one, but a moral one. Do you want to be a creditor to a bankrupt system? Because if you hold paper silver, that is what you are. You are an unsecured creditor to a bank that just ran out of assets. Or do you want to be your own central bank? The countdown has started. 48 hours until markets open in Asia. 48 hours until we see if the government shuts down the exchange or lets it burn. In the final part of this video, I am going to walk you through the 3 specific scenarios for next week and exactly, step by step, what you need to do to survive the collapse. Because when the dust settles, there will only be 2 kinds of people, those who held the metal and those who held the bag. We are now in the final hours. The clock is ticking down to Monday morning, 9:30 a.m. Eastern Time. This is not a drill. This is the calm before the financial hurricane makes landfall. So, what happens next? And more importantly, what do you do right now? There are only 2 scenarios for how next week plays out. Neither of them ends well for the banks. Scenario 1, the force majeure. The exchange declares a market emergency. They suspend trading in silver. They lock the doors. If you have money in a silver ETF or a futures contract, your capital is frozen. They will likely force you to settle for cash at a fixed price, maybe $75, maybe $80. You will get your paper dollars back, but you will never get the metal. While you are holding that devaluing cash, the real price of silver on the street will be screaming past $150, $200, maybe higher. You will have the money, but you won't be able to buy anything with it. This is the rug pull. Scenario 2, the melt-up. The regulators hesitate. They open the market on Monday hoping for a miracle. But there are no sellers. The price gaps up instantly. $85, $100, $120. The algorithms break. The shorts are liquidated in minutes. This is a hyperinflationary event for precious metals. It is the moment the dollar loses its credibility. In either scenario, the strategy for you remains the same. Here is your battle plan for the next 48 hours. Step 1, get out of the system.
If you hold paper silver, SLV, unallocated pool accounts, or leverage contracts, you are sitting in a burning building. You are exposed to counterparty risk. That means you are trusting a bankrupt entity to pay you. They won't. They can't. If the market opens on Monday, sell the paper and buy the physical. If you can't buy physical because there is no stock, buy the miners. The mining companies still have the metal in the ground. They are the only ones with real assets left. Step 2. Ignore the price on the screen. Starting Monday, the spot price is a psyop. It is a psychological operation designed to trick you. If they smash the price down to $50, do not sell. Laugh at them, because that price is for a contract that doesn't exist. The lower they push the paper price, the faster the physical inventory vanishes. It is a trap for the weak hands. Do not be weak. Step 3. Be your own central bank. This crisis is not just about profit, it is about freedom. When you hold physical silver, you have no counterparty risk. You don't need electricity, you don't need the internet, and you don't need JP Morgan's permission to own your wealth. This is the greatest transfer of wealth in human history. It is moving from those who hold debt to those who hold assets, from the paper class to the physical class. We are watching the end of an era. The era of price suppression is over. The era of price discovery has begun. Monday morning, the world changes. The math has finally caught up to the manipulation. Hold the line, protect your family, and for God's sake, don't sell your future for a dying currency. I will see you on the other side.